Lesson 2. So we're going to go over how are stocks traded and on what platforms. So to first do that, let's first go back and define a stock. So in our last lesson, we talked about what a security is, and we established that a stock is a type of security, and it basically signifies that you have ownership of shares of a business, corporation, or company in exchange for capital, and that capital is the money that you put in to buy that stock. So these stocks are usually traded on stock exchanges, and those are public places like the New York Stock Exchange or the NASDAQ, which we'll go over in the lesson. But those are places where you can buy and sell stocks. And you can also privately trade stocks with other traders, but the NYSE and the NASDAQ are the most common places where stocks are traded. Additionally, stock trades are regulated by the government, especially here in the US. There are certain regulations, certain laws put up to monitor how stocks are being traded in order to make sure illegal activity is not taking place. So, a minor distinction basically for taxes is that owning stock means you own shares and you don't technically own the corporation. It's not that important, but just a minor distinction for taxes. So, what are the benefits to owning a stock? Obviously, in that you can earn money, but you can also lose money. What other benefits do stocks provide? Well, they give you a vote in shareholder meetings. So, in return for having a certain amount of shares for owning shares of the company or the corporation, you have a certain voice, and you get, depending on your percentage, you get that proportionate amount of percentage in the shareholder meetings, which govern how a company or a corporation works. So, for example, if I own, let's say, 10% of a super large company like Google, then I would have 10% share over what goes on at Google, and I'd have a 10% voice of the activity that Google has. And additionally, if you own stocks, then you are also eligible to receive dividends. And dividends are basically where some companies will give out the money that they make, and they'll distribute it to their investors. So those come in addition to owning the stock of the company, and so that's an added benefit. So whenever we want to trade stocks, we have a company like Apple. Well, in order to trade them, we have to have the stock symbol. We have to know what symbol their stock is associated with. So, for example, Apple, it's AAPL. And for Amazon, AMZN, Walmart, WMT. So whenever we want to trade a stock, we'd enter that stock symbol. And so that's like the company's unique ID or the stock's unique ID. And that's what we use to trade the stocks. So, what are the two types of stock? We have common stocks, which are what I went over right now, where you get dividends and voting rights. And then you have preferred stock. And those don't give you voting rights, but those give you priority for dividends. So, what that means is that, so let's take Larry Page, for example. He owns a lot of preferred stock of Google because he's the co founder of Google. And what that means is that while he may not have explicit voting rights with that preferred stock, what that means is that he gets dividends first, and he gets a larger share of dividends first over common stockholders like you and me. So common stockholders are uh, lay people like the common public, whereas preferred stockholders are generally company executives or company heads or founders like Larry Page. Okay, so stock market and stock exchange. So it's the place where stocks are bought and sold amongst traders, and those can be in person or virtual. So, for example, the New York Stock Exchange, it's the largest stock exchange in the world, probably the most famous as well. So, that involves, you'll see images commonly in the news of people staring up at computer screens, and that's the most common image of stocks trading in Wall Street in general. And so that can be an in person trade where you have brokers going and calling in trades. But then you can also have virtual stock market exchanges. So those can be, let's say, E Trade, for example. A common shareholder like you or me can go and put in a trade on E Trade, and then that stock will get executed via E Trade. And E Trade may go through the NYSE, but for you and me, it's going through a virtual broker. So that's the distinction between in-person and virtual. Now, going back to the NYSE, when I said it's the largest stock exchange in the world, that means that it has 2,800 companies, mostly within the United States, and it's the largest valued stock exchange. So, in addition to being extremely large, it has a large amount of companies that can be traded, can be bought and sold. Their shares of the stock can be bought and sold on the NYSE. Now, the second most common stock exchange in the world, or second most famous, is probably the NASDAQ, especially here in the US. So the NASDAQ is famous for having a lot of technology companies. So companies like Apple, Amazon, Facebook, Netflix, Google, those companies are all traded on the NASDAQ. And the distinction between the NASDAQ and the NYSE is that the NASDAQ is an electronic stock exchange. So it doesn't involve as many brokers and as many stockholders as the NYSE does. And some of the other famous stock exchanges around the world are in Japan, Shanghai, and London. So those will primarily trade stocks of companies in those countries. So Japan, China, and England. So these tend to represent not only the area or the geography of where they are, but also the largest companies in that area. Okay, so that about wraps it up for this lesson. So I hope you've learned something. If you liked the lesson, go ahead and subscribe and give it a thumbs up. With that being said, thank you for watching, and I'll see you in the next lesson.